Well, this is the perverse thing when you use leverage like I do in my group of businesses. Ultimately, bad macro news often means that rates might come down, which might be a little bit self-serving. But I've asked the Bank of England rep when I was at the meeting recently, and what they said is if unemployment goes up a bit more than their modelling, and their model has only put unemployment up at 5%, we're already there. I think we're more likely to go to sort of 5.5 at some point next year, and that increases the probability of interest rate cuts more quickly, because ultimately part of their job is to stimulate and safeguard the economy, and specifically the unemployment rate, not just inflation. Quite a bit of the inflation is going to drop out, and that's mathematically, it's what we call base effects ultimately. So the shocks that were caused by the employer's national insurance rise, that's going to drop out the figures early next year. We're going to lose between 0.5% and 1% of inflation organically, and that'll take us back to more like the 3% range, where everybody starts getting a lot more comfortable than when we're bumping our head around 4%. Yeah. Inflation for property investors is, we probably benefit more than anybody else apart from the government, depending on how many index-linked bonds they've issued, because we borrow money in nominal values and rents rise with inflation, everything else rises with inflation, but the debt stays fixed. So ultimately, if we've got some capital growth, which again I'm positive about over the coming year and the coming 5 years or so, then we get to outstrip that nominal debt that we've got attached to our assets. And a 3% inflation rate is actually far better for us than a 2% inflation rate. But if it could come back to 2, then ultimately we will see cheaper interest rates again, which we would also benefit from. So it should be a win-win situation, as long as I'm right and we're on the downward slope, Duncan, anyway.